Initially, the MVP is based on following traditional AI way of work, so using some of the tools that are already on the market, but also improve the new tools and even models and so forth.
Okay, so who in here has a finance background? Okay, so one person. What's everybody else's background? You want to just yell it out? IT? Okay, anybody else? HR, okay. Speak up a little bit, please. Marketing, okay. Any other industries? Okay, fine. So we got two finance people. In the IT industry, what industry are you in?
Staff augmentation and outsourcing.
Okay, great. Well, what I'm going to talk about today, and feel free to ask questions. I'll just give you a quick overview of my background, right? So my background, I worked in technology for almost, I'd say maybe 15, 16 years, and thought about doing an MBA, and ended up having a PhD program that was nearby, right, where I was working. So ended up just doing the PhD. At that time, I was not married. I had a lot more free time. So just pursued grad school, did a PhD in modeling and simulation. I was working in the aerospace industry. So we were building flight simulators. And I remember one weekend, they had this thing called Startup Weekend. And it looks like we just lost the connection here. Oh, there we go. But that kind of changed my life, because that weekend, essentially, what you were supposed to do is build a startup in 1 week, in one weekend. So I had an idea. I published a book, for my PhD, and I came up with an idea to develop a technology that can publish a book. It formats the book and everything. And we came up and pitched the idea. Nobody wanted to join my team. So there was two kids. One guy was an engineer. Another guy was a finance guy. And they came up with an idea to deliver tampons. And this is the time when, there's a company called Dollar Shave Club, right? Dollar Shave Club, what you can do is you buy razors and they just ship the razors to you, right? So it was an on-demand delivery. That was a huge thing. And what we realized is sometimes there's a need for different types of tampons. It's a women's health kind of company. And I didn't have anybody that wanted to join my team. I said, you guys have an idea. And there was a few people that joined the team. So at the end, we won second place. My superpower was I liked kind of thinking about the product, and I pitched. I was kind of doing, kind of like a sales role, and we pitched and we won second place. So after that, I fell in love with entrepreneurship, but I didn't know if I wanted to be a founder. So after that, I finished my PhD, and then I moved to New York and, got into finance. And after that, essentially, launched my own investment firm, and really was passionate about education because I had a PhD and built an education company. And what we do is essentially help people get into finance meaning private equity, venture capital, investment banking. And then the next step after that, a lot of people, what they do is after they get into the industry, they launch their own fund. You could be in IT, you could be in healthcare, you could be in cybersecurity. No matter what the strategy is, you can put capital around it to scale. So some of the companies that I've invested in, some of the well-known companies, Klarna, Robinhood. There's a company called Carta. They do a lot of the cap tables and back office. So my background, if you think about it, was finance and then technology. And if you can use your skills, you could put capital around it to kind of scale, right? Everything is going to need capital. So what I'm going to do today is just talk about, if you do want to make the change, and it's really about what you guys want to do, I'll talk about what's helped people make the shift using your tech background, your marketing background, your IT background, and use those skills, learn finance, and then make the switch. And then later on, what people do is, if you know how to raise capital, if you're good at storytelling, you can go out and raise capital and launch a fund. So we've helped people do that. And essentially what we do, in terms of how to achieve that is obviously give hands-on learning. We teach you the financial modeling. You get a one-on-one coach with someone who's in private equity. And then the big thing is the network, right? They say your network is your net worth. So if you're around a bunch of people that are doing cybersecurity, the network is going to be around the cybersecurity industry. If you're around a bunch of billionaires, your net worth may be different. And then if you want to launch a fund, one of the things you want to think about is, why are you launching a fund? What's the purpose? Is it that you want to just get into the industry of being an investment manager? Do you want to go out and raise capital? And what sectors are you interested in, right? So what we do is we'll help you learn how to raise capital. We have an investor community. And then obviously if you want to actually formally legalize this, you set up the fund, talk to lawyers, set up the tools that you need to have the infrastructure to do that. So people, get into the investment management industry from all walks of life, because when you go to college, there's no degree called private equity. There's no degree called venture capital. Most people, they learn finance, they learn accounting, and then somehow they get into the industry through their network. So, people can come from all walks of life. And, really, if this is the career that you're interested in, I do believe there's a lot of growth, there's impact, and, obviously it's a really high-paying income, paying role as well. Some of the people at the end of their career, if you think about like Mark Andreessen, if you think about, obviously Stephen Schwartzman, he runs Blackstone, he's worth $52 billion. So I think, what they say is, you make your millions in real estate, you make your billions in private equity. Elon Musk, right? He's not rich because he's managing Tesla. He's rich because he's done private equity, right? He's done private equity roll-ups, and he's been able to get combined companies together to increase larger and larger shareholder value. And he's been, some of the people that have made the most people wealthy, whether it's his investors, whether it's his partners, his shareholders, the people that work at his company. A lot of generational wealth has been created from asset management and finance. These are just some examples of people that have different backgrounds that got into the industry. Again, this is why I think this is exciting. So with venture capital, you're investing in early stage companies. If you invested $25,000 into Uber, that would have been $124 million in 10 years, right? So there's large outsized returns, but it takes a long time. When you think about private equity breaks out mainly, when people usually reference private equity, they talk about growth equity. That means helping the company scale and raise more and more capital so they grow faster and faster. And then they think about buyout. That means, look, I have 5 accounting firms. They're all making $3 million a year. We're just going to buy all 3 of them and then make it worth $300 million, right? So you're increasing value, buying a company, making it worth more, and then selling it to a larger platform. So that's essentially venture private equity. This was the example of Uber. As you can see, this is, you can't really read it here, but this is one of the early investors that invested $25,000. If you invested $200,000, that would have been $1 billion, right? So this was one of the founders that founded StumbleUpon. His name was Garrett Camp. So he sold his company for, I think, a couple $100 million. He put $200,000 into it, and then 10 years later, turned into $1 billion. You don't necessarily have to wait 10 years. You can also wait till year 5, and the company's worth more, and get like maybe a 30x. If you think about it, 25,000 to 124 million is 5,000x multiple. Right? So you kind of compare that to the S&P 500 or pension funds or your retirement accounts, there's a huge difference, right? Any questions so far? Okay, so everybody understands everything. What is a fund? A fund is a pool of capital, and you can take that capital, you raise capital, and you can invest in different things. It could be real estate. It could be tech companies. It could be public markets. Public markets would essentially be called a hedge fund. Private equity means you're investing in private companies before they go public. And the main goal is hopefully you invest in these assets and you make money for all of your investors, and then they invest in your next fund, right? So essentially what you do is you raise $100 million, deploy into maybe 50 companies. You turn that $100 million into $300 million, and you say, hey guys, I gave your money back, you're welcome. We're going to do fund two. We're going to do 300 million, right? So the game is really charging management fees and returning capital. So if you have a $100 million fund, you can charge 2% management fee every year, right? So if you have a $10 million fund, that's 20 million, right? So a lot of entrepreneurs, what they do is they'll do really well in their career. They sell their company for maybe $1 billion and they just don't want to do it again. So they decide to just manage a fund and just deploy capital and have other founders do the work, right? The founders have to, go out and tell the story. They have to do marketing. They have to, build a sales team. They have to continue raising more money. And many people in the later stages of their career, they just don't want to do it. They don't have another company in them, right? So they're just going to be an investment manager and mentor new fund managers. So what the job is like, because I know a majority of you come from different industries. One of the things that you do every Monday is your sourcing and screening. You get deals coming in, inbound. You get deals coming in from other friends. We had somebody here just, tell me right now that they're building a really cool fintech company. So you have conversations with people, you meet other investors, and that's how you get deals. You source them, but then you want to screen them. When you screen them, you need to decide, is this a good investment? Should I put more time into looking at this company? And is it worth my time? And what are the risks? So when you look at the risks, you're going to do due diligence and look at their financials, look at their cap tables, look at who the other investors are. You're going to do some financial modeling. Is this going to be a 5,000x return or is it going to be a 10x return? How big is this, investment opportunity going to be? What is the size of the return, right? And essentially, when you have a really hot deal, when you have Uber, there's only maybe, in the early rounds, there's maybe 6 investors that can get in. Each investor is writing a couple $1 million. So you have to also win that deal. A lot of times there's a lot of other competing investors trying to get into the startup. So as much as you think that startups need money, you also have to sell yourself to convince a startup to take your money, because there's a lot of smart money out there. So that's closing the deal. Then once you invest in a company, you need to monitor that investment, right? Does that investment need more capital? Has that investment, has the portfolio company, the founder of the company had any issues? Are there issues, specifically with the company that's going to impact its growth? Have they had compliance issues where the company has to shut down, right? So you're monitoring those investments. You also have shareholders that want updates from you, so you want to give those updates to those companies. And then obviously you're always networking, right? So the relationship building is super important. So if you don't like people, then this is probably not a good industry for you, right? So any questions? Any comments? Tough crowd. Has anybody looked at, private equity or venture capital as like an opportunity to invest or, okay, tell me about it.
We have venture capital, and I used to work at a company
Mm-hmm.
doing M&A,
Okay,
and then we switched to a venture capital, and we have bought 3 companies right now.
great.
One is cool. One is a pharmaceutical company, and one is a sports and leisure company.
Okay, cool. So you started, a fund with some friends or just kind of, okay, great.
It's not a private equity. It's more like we do like a search fund model.
Oh, cool. So you take the company, you join as an operator, and you scale it. Yeah.
4 years.
Sure.
Another one, and then one of the friends also happens to be the investor guy, so he's like the private equity.
Yeah.
So we do like holding companies.
Sure.
Instead of selling, we want to do like a lot of holding companies
Yeah.
in the same sector.
What's the biggest thing that you learned doing that?
Turnaround, right? Turnarounds
Yeah.
are hard.
Sure.
And so don't go to turnaround.
Yeah.
Don't see or don't buy
Yeah.
any company that is a turnaround.
Sure.
It's almost impossible
Yeah.
to flip it around if
Mhm.
you don't have a lot of capital backing you up.
Yeah.
And so that's the main thing.
Yeah, so that's search funds is a very popular thing when people go to Ivy League schools, right? They go to Harvard, they go to Wharton, and they're like, look, I'm going to graduate, I'm going to buy a company, I'm going to buy, a manufacturing company. The issue, in my opinion, is you're giving yourself a new job, right? You have to come in and operate the business. Yeah. So you're coming in, you got to do the work. Where as an investor, you just give money to Uber and say, hey, figure it out. The people, the marketers, the salespeople, the mobile developers, they do the work. You're using capital to do the work. So essentially, you get that freedom from not having to do the operational work, but you still have another job, right? You have to go out and raise capital. You got to find these companies. So it's still work. It's just a different flavor of work. It's difficult to do that kind of work when you're 70 years old, 80 years old. Where if you think about Steven Schwartzman, he's 80 years old. He's still managing an organization, and he's they're in the business of managing, deploying, and monitoring capital, and then raising more and more money, right? So you're just selling money, essentially, right? It's like, look, do you want to buy this product? This is a $100 million fund. If you invest, you get exposure to healthcare. If you invest in our, all-weather fund, you get access to cybersecurity, infrastructure, and more conservative investments. So you can have, once you have your first fund, you get judged on that, and you're showcasing your track record, essentially. And a lot of people start with the search fund model to showcase their track record. They're like, look, I started this search fund. I've taken these companies from 500,000 to 3 million. I've done this 3 times. I'm exhausted. I'd rather just launch a fund and just invest in portfolio companies where there's a founder that's doing all of that, right? So this is kind of just a high level diagram, but if you think about it, the exit is bigger, in terms of proportion if you go in early, right? But you got to wait 10 years. If you do private equity and essentially growth equity or buyout, this might take maybe 5 to 7 years, and this is taking longer and longer with private markets, just extending, people doing continuation vehicles. SpaceX is still private, right? It's been private for a long time. They did have a really interesting M&A, activity that did happen. So I think a lot of that is going to get rolled up and consolidated. But you essentially invest early, get outsized returns. Those checks could be smaller. Usually when you're doing private equity, if you're doing growth equity, those checks are going to be a lot bigger. They're going to be like 30 to 50 million, and you might get a 5x multiple. But if you 3x, 30 million, that's still 90 million, right? So you had a question?
On your line of work and what you have invested in, what is your preferred method, VC or private equity?
So I've done a combination of both. I've done growth equity and VC. Most of my investments have been in VC, and I've invested in the industries that I know. I worked in the aerospace industry. I got a PhD. And then I worked in fintech. I worked in financial software. So I just, focused on those areas. But I also was very curious to get involved in other industries as well, just out of curiosity. So if you guys go to my website, if it's of interest, I have a podcast. And one of the companies that we invested in, if you go to podcast, I just went live today. I have a live stream here. This guy here, actually, it should be coming in a few hours. But we had a hydrogen energy investor come on, and pretty much they built these hydrogen storage companies. So I'll kind of show you his website. But really interesting entrepreneur. So his background, his family, they come from the Coors beer family. So essentially the family, his name is Andrew Coors, but he essentially built technology to store hydrogen energy. So for me, I was interested in aerospace, and this is a really, important solution that they're providing because, hydrogen and clean energy, it definitely is the future. There's a lot of industrial opportunities. So I invested just out of curiosity, and a lot of times you can learn a lot just from meeting the founder. I knew nothing about hydrogen energy. So if you're excited about things, those are opportunities too. Also,
How is AI changing your perspective on early stage investment?
yeah.
Because anyone can put a company in 2 minutes and
Oh yeah.
right?
Sure. And we're going to do that today. We're going to build a company. We're going to build a website or an app using AI. But you're right. But you can't really. So, there's pros and cons with everything, right? So with this, you can't really AI automate this because this is a physical, steel vessel. AI, I would say, is a very crowded market, and all the funds that were doing crypto, they're just saying they're doing AI now, right? Because nobody's really interested in blockchain and crypto anymore. So I think as an investor, you're going to see a lot of noise and everybody's an AI company. I think what's really exciting is it's going to unlock a lot of scalability, and companies are going to, grow and scale much faster. I think you still need the sophisticated developer tools and developer infrastructure. If the app is more complicated, and I built a few apps in the past using AI, but once I started getting more complex logic, you can't expect the vibe coding tool to kind of fix all that. So a lot of times you still need the infrastructure, the team, and I mean, you guys are in IT, so you guys definitely know this, right? But I think, look, it inevitably, I don't think it's going to take away jobs. I think it's going to open up more jobs because if engineers, most of their workflows are automated with AI, someone still needs to build the AI. Also, that AI, if you want to scale and invest in it, you need more capital. So I think there's going to be a lot more opportunities in the private equity space to invest in AI, and then I think you want to think about the different pillars of AI. But I've invested in a bunch of B2B SaaS companies. We've looked at a lot of AI companies and also cybersecurity companies. What I'll say is there's a whole concept of the death of SaaS. So right now, when you invest in a SaaS company, you're hoping that company is going to scale and sell multiple seats per month, right? The way that AI is heading now, they're monetizing based on credits. So if you want to, plug into an AI tool, they're going to be charging you based on credits. So I think that's kind of an important thing. How are the companies going to monetize and scale, and how many more credits can they sell? So I think that's an important business model. Yeah.
Going back to your VC and private equity.
Mm-hmm. Yeah.
When you invest in VCs, you normally do a safe. Those safes normally have a cash out versus all cash in. And then when you do private equity, you prefer straight equity or convertible debt. And why?
So I would say with venture, if you do an early stage, it depends on the valuation, right? I mean, there was a vehicle called the SAFE that was used because it's just a standard template that everybody uses. And essentially what you're doing is you're investing at a standard valuation. And the benefit of using a SAFE early on is it's just the same document that everybody uses. So it's cheaper from a legal perspective instead of drafting a custom legal document. And if you go to ycombinator.com, you can pull up the SAFE. It's a simple agreement for future equity. Equity versus debt, to just make it super simple. Equity means I'm going to invest in your company. You give me, 5% of your company. Debt means I'm going to invest in your company and you pay me, 10% interest, right? So most VC is usually a SAFE or a convertible note. Yeah, it's simpler. I mean, you have to get a lawyer to draft a custom agreement, and then there's legal fees that you got to pay as a founder. You don't have any money usually, right, at this stage. So it's just a standard template that you use. If you go to Y Combinator, if you look up Y Combinator SAFE, you could just pull the template and. What's that? They did, yeah. I think they did. Yeah, they were one of the early. They're a really large startup accelerator, and they just wanted to make it easy for founders, right? Once you get into private equity, yeah, go ahead.
What happens if you are in seed round and you have 10 guys that want to put money in your seed round, and 9 want to save, and the other one want to equity, for example? What do you do?
Well, there's only one document, right? And you want to make it not as messy because then you're going to piss off all the other investors as well, right? So what you usually say is, hey, you know what? We're one of the hottest AI companies right now. We're already at 500K in revenue. Look, we're raising $2 million. We have 500K left. Let me know if you're in or out. We're closing our round in 2 weeks. So it's like, if you try to do a custom agreement for this one investor, unless this investor wants to come in and put 10 million, right? If he wants to put 10 million, you can move everything around. But usually you want to make it easy enough to close the deal. If you have too many complexities and you have like 8 investors that want to do one thing and another thing, then what happens is the entire deal falls through, So, any other questions?
No, I don't say normally you have a cash out or normally all cash in.
When you say cash out, can you clarify?
The founders for their share and the rest of the money goes into the business.
So, when you're investing in an early stage company, if you're just directly investing as a fund or an angel, you usually just sign the document and you wire it to the founder. And then the founder is supposed to be using that money.
It's cash in, on early stages of get cash out normally, until it has gone through all
Yeah.
the seed.
I mean, you're only going to make the bad thing about venture is you may invest maybe $2 million into a company. Hopefully they take the $2 million and scale to become let's say you invest $2 million, the company is a $10 million company, right? Hopefully that $2 million, that money, the founder is going to take the $2 million and turn this $10 million company into a $30 million company, right? You're only going to get your money back if that company sells to Google, right? And then they sell the company to Google for, 50 million. When you got in, it was worth 10 million. The company's now worth 50 million. So 50 minus 10 is 40 million. And then whatever the pro rata percentage of the shares that you have, that's how you get your money. That's how you get your cash out, essentially. So in private equity, a lot of times these.
I meant cash out for the funder of the startup.
So the founder. Yeah. Well, I mean, that's an accounting question, right? So you give, $2 million to the founder. If I'm an investor, I'm hoping they.
One is mine,
Mhm.
my bank account, and the other one goes to the business.
Well, when you're doing your accounting, right? You have your gross revenue, right? And then you have all of your expenses, and then you have EBITDA, right? That's what's left. Earnings before tax, interest, and amortization. There's a percentage where you're going to give yourself a salary, right? You're an employee of the company, so whatever the salary you give yourself, that's what you are earning, and you're going to be sharing your financials with the investor. And it's a process of good faith, right? So usually when you're doing your bookkeeping, your accounting, you should be giving yourself a somewhat reasonable salary. You're not going to go and buy a Lamborghini or a yacht and put it in your personal account. Hopefully people are, using the capital. It could happen, yeah. And I mean, there's a lot of people that went to jail, because they're not using the proceeds properly, and the stakes are much higher, especially when So in growth equity, some of these rounds, there's an institutional investor that comes in, and it might be a hybrid of equity and debt, where there's like a big, huge venture capital fund like Sequoia Capital. They put in $250 million, and then there's a $1 billion check from Fidelity, right? So one of the companies that I invested in, they got a big check from Fidelity, and they just do debt, right? So there's going to be different flavors, and that round at that stage, it may be a hybrid, and that's why I mentioned here, they may be a hybrid of debt and equity together. But in the early stage, it's just going to be usually just equity. It's more simple, right? Or else it's going to be really complicated.
Hurdle rate are you using when you invest as a private equity fund?
How?
The hurdle rate. Do you apply a hurdle rate?
Not. I mean, the fund usually, if you're doing private equity, there really isn't a hurdle rate. Hedge funds, public markets, when you're investing in stocks, there's usually a hurdle rate. That means, hey, we will only take our fees if we hit 20% in IRR, right? Those are usually the hedge funds do that.
I work at private equity fund in Argentina, one of the biggest. And
Yeah.
They use the hurdle rate.
Yeah, I mean, I think when you become a more sophisticated, if you're like a couple billion in assets, they probably have requirements and terms when you're raising capital to hit the hurdle. I would say the smaller private equity funds, sub 100 million, they usually don't have a hurdle. They usually just kind of showcase their track record, and they say, look, because a lot of times it's hard to predict, what your performance could be, right? There could be a down round. Bill Ackman, he mentioned this, I think, in the news one time. I mean, Bill Ackman was getting sued because his fund was down by 30%, right? So a lot of times, I mean, you can get sued for anything or any reason, but a lot of times if you're misrepresenting your fund and saying, look, we're going to get you, 50%, returns every year, and the fund underperforms, then those are kind of the things that you want to prepare for. So the hurdle rate, that's going to be written in your fund documents. They have this document called the Limited Partnership Agreement, where investors, before they invest, they're agreeing to the terms, right? So some of the investors, before they agree, they're going to say, look, I need to see a 20%. I'm not going to invest in your fund. That's at the fund level, right? That's not the company level. It needs to be a certain performance, and if you don't perform, then I don't want to pay the fees, So Again, I mean, I think it's always good to be part of a community or a mentorship. It seems like you guys are part of a great tribe. And then these are just other people in our past that have gone out. Christian actually started a fund called Bachmanity Capital. He's done really well. And these are kind of, some of the people that have gone through that. And I think if you want to do this on your own, I would kind of just try to build the theory. You could probably find a lot of these resources on the internet, on ChatGPT. We have also a lot of free templates on our website, so check those out. But you know what? You want to be in the community with people that are investing capital, right? So it's probably where you guys live and where your offices are. There may be communities of investors and other people that are managing capital. So if if you're interested in this industry, try to be within those platforms and communities. And for us too, what we've done is kind of helped a lot of people do that. We do it a little differently because we instead of kind of going back and doing a 4-year degree or going back to business school, we kind of try to accelerate this with the platform, the community that we have. And essentially, if you want to launch a fund, you want to kind of build those skills and kind of get into those rooms, right? So if you guys want to learn more, feel free to email me. Our website is suttoncapital.co, and these slides are embedded on suttoncapital.co/slides. If you just go to Sutton Capital, it's right here. So suttoncapital.co/slides, and that same presentation is there. But any questions? No questions at all. Any comments?
Can you go back to your email, please?
The slides?
Yeah.
Oh, the email. Yeah. Yeah, it's my email. I would say, I guess if you want to start a fund, has anybody thought about starting a fund?
I started a fund, but I used to work in JP Morgan, investment banking.
Sure.
Then private equity, 2 or 3 years ago for Tiger Global Management.
Oh yeah, Tiger's huge. Yeah.
And then I started my own fund, but in capital markets.
Okay, in public markets. Yeah, okay. And then maybe you can tell me about, I guess you said you were kind of building a business that you were...
I have a wealth management platform.
Mm-hmm.
Basically, 3 layers, B2C, B2B, and private markets.
Okay,
And we manage over $30 million.
okay.
And since inception, we've been profitable.
Yeah,
And we're growing in Latin America specifically.
That's great.
We connect Wall Street with Latin American investors and advisors because we have the B2B and B2C.
sure.
And now I don't need money, but I'm looking to raise a Series A.
Mm-hmm.
Not much, I don't really need it.
Yeah.
I can do it myself. But to grow more than money, I need somebody to help me map the growth in Latin America. And
Sure.
then, like 2-3 years, exit to an strategic.
Yeah.
buyer.
Yeah, I mean, the only thing you want to think about is, there's always strings attached when you take money, right?
That's the thing. And
So,
I don't want anybody in my company.
yeah,
It has to be somebody that has connections, that has expertise, that understands the fund business.
exactly.
I know who I'm going to sell the fund to. I
Mhm.
already know that.
Sure.
There are 2 or 3 strategics that will buy my fund in the
Yeah.
next few years. When
Mhm.
I take, I don't know, $100 million.
Yeah.
80 million.
Sure. Yeah, and I would say, the valuation is a huge thing. So if you're at 100 million in revenue, right, you want to think about what the valuation is. So it's a multiple, right? So if you're at 100 million, it's usually based on EBITDA, right? So if you're making, 50 million in EBITDA, that means your profit, right? There's a multiple that you tie that to, right? So we're, Sutton Capital, we invest, we also have an education company. And if I ever wanted to sell it, I would look at comparable companies, right? Comparable companies that do online learning in Wall Street training, right? And what's the EBITDA that you need to think about, and how big can you sell it? Some people, what they've done is they've scaled the company and they sell half of the company. They still own it, they still operate it, but they don't want to get rid of the entire company.
I'm selling also half of it.
Okay, that's great.
The half I'm keeping.
Yeah. So, and then, you could keep it. I mean, look, you can give yourself a distribution. A lot of people, the problem is some of these people, they started companies and they've been running the company for like 10 years, right? And they've never had a break. And now they've got kids. They want to send their kids to a good school. And that's a good opportunity for them to kind of sell some of their shares and, get some cash back because they've been doing this for almost a decade, right? And if you think about it, if you're like 40 years old, it takes a decade to kind of launch a fund, to deploy capital. It takes maybe a decade to launch a company. you got maybe 4 more chances, right? And then you're 80 years old. So you know, time I think is a big thing too. People that have 40 years ahead of them, they can maybe do venture capital, right? But once you hit 50, you may not be alive when the company has an IPO, right? I mean, the company may still be running, and you may be you know, kind of thinking about assisted living. So that's kind of another thing too that you want to think about, the time horizon to invest. So yeah. Any other questions? Any comments? I mean, what did you guys do? What did you guys eat for lunch today? Tacos. Okay. Yeah, sure.
When the exit is an IPO, like in your experience, does it go really up stock, like really up and then down, or how long in your experience do you have to wait to take out the money when it has an IPO, like an exit?
So, I mean, it could take, you know, Uber, I think, took almost, I mean, more than 10 years, right, for its IPO. So, if you're an investor, you don't have to wait till the IPO. They have a secondary market. So, you can sell some of your shares on a secondary market and get some cash in. Some people just want the money quickly. You know, are you guys, where are you guys all, are you guys all in New York, or where are you guys traveling from? Mexico? Guatemala, Argentina, got it. So in the U.S., I mean, a big thing is tax, right? So whenever you get money, you got to pay tax on it. So if you can take that capital and put it into something else, you know, that helps with getting hit with capital gains, right? So is that an issue? And I guess how do you guys think about that in Latin America?
It's an issue, but it's really small, the tax.
Okay,
It's 5%.
sure. Okay, wow, that's got to be nice.
Nothing,
Yeah, sure.
Well, in Mexico, if you wait for the IPO, then you're gonna be 10% taxable, but if you take the earnings before, you're gonna get 34%.
Okay, short-term, yeah, it's like short-term gains, I guess, right? Yeah. So, yeah, I mean, look, there's ways to exit and get liquidity, and you just got to figure out the ways to do that, right? So if you're in a company, people will help you. You can find brokers that can sell your shares. The brokers get a percentage to facilitate that transaction. You can get out. You get maybe a 5x, right? Yeah.
Like, you know, after an IPO, there's a lock-up period where you cannot get out.
There's a 6-month lockup.
Right.
Yeah.
What happens during that time, the stock dives.
Yeah.
You need the money, you can't get out, there's no way to get out.
So, you know, for me, I mean, you learn a lot of times through mistakes, right? And life lessons, right? So, I mean, I stopped doing really late stage deals because the problem is, you know, the benefit of investing late, like 2 years before the IPO, you make money, hopefully you make a 2x when an IPO happens, right? The uncertainty is you don't know if you're going to get a 2x because you don't know what the share price is going to be at, right? So if you come in at the share price of $100 and then the company IPOs for $30, you just got demolished with your value, right?
At the end of before an IPO, you get valued by the big banks, basically, right?
Yeah.
So it's a different type of valuation than
Absolutely, yeah. I mean, Robinhood popped during the IPO. I think they were like $70 a share, and then 6 months later, the share price was like $8. The good news is the price now is like, I haven't checked, but it's I think a couple $100 now, right? So, but the problem is you're waiting again, right? You're hoping to get an exit. Now you're locked in the public markets, and now you're stuck in like a public market stock, and that could take another 6-7 months. You could have just bought Robinhood at $8, you know, instead of doing all this work. So that's something to think about when you invest really late stage. A lot of people do pre-IPO because they're like, look, I'm going to do $2 million into SpaceX. If I just get a 2x, that's $4 million, right? But SpaceX still has not IPO'd, right? So you could be sitting in SpaceX for a long time and then hoping that they're raising another amount. So it's kind of a game of, you know, time is a big thing. The share price is a big thing. The entry point. The two biggest things is your entry point price and your exit point price. And hopefully your exit point price is more than your entry point price to make money, right? So, yeah. Was that helpful?
What is your opinion on IPOing or dividend? Like, if you can continue a private company a long time?
Yeah, I mean, I think,
IPO or why wouldn't you?
so there's either what I would think about, I mean, an IPO, you have to do an audit, you have to, you know, pay for an IPO. I have a good friend of mine, his company makes about $1 million a month, and he's planning an IPO. He's doing really, really well. I learned about his journey. He had to do an audit with a big consulting firm. He's got to really go through his financials. He has to pay a lot of lawyers. So it's very capital intensive. But his dream is to kind of just run a public company. That's what he wants to do, right? So you also have to think about what your goals are, right? Some people that were founders, I mean, if you remember, Travis Kalanick is not running Uber, right? I mean, he got kicked out a long time. Some people are great at the early stage to be that scrappy founder, but then when you want to be a grown-up, you got to get, you know, like the executive from Expedia to come in to run Uber, right? So sometimes you grow out of your shoes, and you know, when you're a venture-backed CEO, a lot of times is going to be different than a public company CEO, right? There's a lot of regulation, a lot of transparency. So you got to decide if that's who you want to become. Some people, they'd rather just do an M&A transaction where they just get cash. It's maybe a combination of cash and shares. And then with the cash and shares, you have to stay at the company for maybe 4 years. And then after those 4 years, you can exit and do something else. You know, I know someone that sold their company for $200 million to a bigger bank. They worked at that bank the agreement is they had to work at that bank for 4 years, make sure it's a successful transition. 4 years later, they networked with a lot of people and they launched a venture fund. They don't want to launch another company again. So that's usually the transition, right? You're an executive, you work in private equity, you work in venture, maybe you start a company, and then a lot of times later on, you know, people start a fund. I'm very proud of, you know, somebody that I back. There's a fund called Behind Genius Ventures. I met Paige, I think she was like 23 years old or something. So she's probably 24. And I am a early investor in Paige. She's like a Gen Z, but she just started her fund, you know, just kind of right out of, she worked in tech for a few years, and in her 20s, she started a fund. And you know, you're going to see a lot more younger people just go out and raise capital, right? They're building communities, they're doing stuff on TikTok, they're building an audience, and those people follow them, and then they kind of, you know, back what they're doing. So you're going to see a lot of people now just go directly into fund management because just, in my opinion, I think it's a lot more lucrative. So yeah, that's all I got. Anything else? Yeah, that's the stock, the prediction market, right? Yeah. Oh, that's great. Oh, wow. Okay, yeah. Sure, yeah. Yeah. Have any of you guys thought about starting a company? Nobody at all? Starting a company, being an entrepreneur. Oh, everybody's already an entrepreneur. How many? Oh, I should have started that earlier. How many people are entrepreneurs? Okay, wow, okay. I should have asked that question earlier. So tell me, I guess, maybe just yell out what you're building.
In my case, it's aerospace. So
Okay, so aerospace, like...
in-orbit service.
Oh, in-orbit service. Okay, cool. And how'd you get into that space?
Long story, but we are building the company with co-workers. So.
Sure. Okay, great. Well, you know, I know we have about 30, 40 minutes, so I thought we could just do a fun exercise. Maybe we'll just break up into like 3 groups. So I want to have, how many people want to launch a fund today? Like for fun, like an exercise? Okay, only 2 people. Okay, come on, be proud, you know? Don't be shy. So how many people? Keep your hands up. Okay. So there's, okay, so the people that have their hands up, go to this corner here, please. These are the people that are going to be writing checks. These are the people that you need to court and hopefully convince them to give you money. So all the fund managers, come over here. And maybe bring a laptop with you too. So whoever wants to write checks, launch a fund. We're gonna launch $100 million today. Okay. So these. Okay, pesos is good too. I'll take anything. Okay, so these are the fund managers, and then we're just gonna start two companies, right? This might get messy, but maybe have these two rows go in this side, and then the back two rows go to the back. And what I want you guys to do, maybe bring a laptop with you. I want you guys to, yeah, so let's get everybody situated first. And if one of you guys have a laptop, okay, okay. Oh, you guys don't, none of you guys have a laptop? Okay, okay, all right, that's fine. They can sit, yeah, they can sit. Yeah, you guys could sit, yeah, yeah. Okay. Okay, so listen up, guys. So if you want to start a fund, right, some of the things you want to think about is, what is your strategy? What is your investment thesis? Are you investing in healthcare? You know, so there's a couple things. Ready to take notes? So how big is the fund, right? So maybe take that down. How big is the fund? What is the investment strategy that you're investing? Are you investing in fintech? Are you investing in healthcare? Are you investing in climate? A lot of times people choose this based on their industry background, right? So there's a lot of aerospace funds. I'm in a couple rocket companies as well because my aerospace background, right? So what is the fund strategy? You can't invest in everything. That can be the strategy. Stage, yeah. So early or late stage. How many years is the fund? Like, so is it maybe do 7 years, right? And if you think about it, if you have a $100 million fund, it's 7 years, you charge 2% management fee. 2 and 20. Yeah. 2 and 20. And then what do you look for in investing? Yeah. So maybe think through that. Maybe you guys can brainstorm, and then we can present and have some fun. And I mean, if your sector is outside of what these these are going to be two companies, right? If it's outside, say no, yeah, we're out, no. But like maybe from an investor standpoint, say, hey, you know what? Like I like your idea, but it's a competitive space, you know. I mean, and maybe address your concerns, right? So maybe think about it from like a VC's perspective. I have like an AI tool that I've built that can allow you to build the fund, you know. So that's why I thought it'd be helpful if you had a laptop to try that out. But it seems like nobody. Oh yeah, bring your laptop. Yeah. It's a platform that I built.
Okay.
It's vcprivateequity.com. That's the website. So if you go there, you can actually build out the fund. I'll show you real quick.
We did a CPG.
Yeah.
CPG
Mm-hmm. Yeah.
was the first one in Central America.
Okay.
And we did a model because
Yeah.
you don't have numbers, you don't have anything. So
That's great.
the valuation and how you evaluate the founder is a little different on an early
Oh, I
stage
love
and
that.
late stage. Whatever, here is late stage or whatever we want to.
Yeah, just whatever you think, you know. I mean, so and why, right? Because some people, they want to do late stage because they don't want to do something too risky, right? They want to only invest in companies that are already making 100 million. They're already profitable companies, but then you don't get the huge 5,000x return, right? You get maybe a 5x. So you don't get the outsized returns if you do in late stage, but late stage is less risky. So it depends if you guys as a group are more risky, high returns, or more conservative, right? So, yeah. Yeah, cool. Well, when you get the computer up, vcprivateequity.com, and then go to fund model, and you can build out a model. All right. All right, guys, so both of you groups, listen up, guys. So both of you groups are going to just come up with a business idea. And if you look here, what is the problem you're solving? You know, how big is the addressable market? Why will your team win? But what are you guys building, and what is special about your team? If you were to build this, you know, how much traction do you have? I don't know if you guys have laptops, but if you have a laptop, yeah. So you know, you may not be able to do this. Last time what we did is on the laptop, we built an AI. We built like an AI using a software tool. But you could just talk about your company and nominate somebody to pitch the company and just talk through problem, how big is the market, traction. You can say, look, we're already making, $2 million a month in revenue. And then again, no prototype, but just talk about it, have somebody pitch. And then the VCs they're going to tell you if they're going to invest or not and why. All right? Cool. So you understand what you guys are going to do? Okay. So you guys are going to start a company,
Okay.
right? So what is the problem? How big is the market size?
Okay.
How big is the market? Why will your team win? And then how much traction do you have? How much revenue do you have? And then those are the VCs. So they're going to decide if they're going to invest or not. All right?
It's the best.
Yeah, you guys are a company.
Okay.
So, yeah.
Okay.
So what's the problem? How big is the market? Traction you have, and then why will you win?
Okay.
Make sense? And then traction, like how much money you're making, how many customers you have. Yeah, that's the traction. All right.
Okay.
And then we'll decide which team wins.
Okay.
So who's pitching on this team? Okay, you're gonna be presented. Okay. All right. Cool. So maybe in like 10 minutes, 10, 15 minutes. No good? Okay, cool. 15 minutes. There we go. There we go.
Can you give the screen?
I'll pull it up. Yeah. And who's going to be pitching here?
Who's the investor?
Those are the investors there.
This is
Yeah,
the
yeah.
investor.
They're the investors. Yeah.
It's the
Your company. Your company. Yeah.
Because there was a group of you that didn't know what to do.
Oh, who doesn't know what to do?
Went to the bathroom, he's here.
Oh, okay, cool. All right.
But, so
Okay.
trying to catch up.
Yeah. So essentially, just come up with a business idea. Who's going to pitch? Who's going to present? You? Okay. All right. So, just take 10, 15 minutes. Hey, I got this startup idea. It's a robot cleaner, right?
Okay.
Robot comes in, cleans apartments. Traction, we're making $2 million a month in revenue.
Okay.
We got 2,000 customers, and that's why why are we the best team? Why should you invest in us, right?
Okay.
That's what you're doing. So,
Okay.
and
Good
yeah,
idea.
yeah. I mean,
Yeah.
wait,
For example, is
yeah, you can use that idea or come up with a better one. You probably have a better idea. So, yeah, cool. All right. Yeah. Okay. Go to fund model, and then you could essentially build the fund, right? So if you're doing a $100 million fund, and then you can add the check size, right?
Miren.
So it's kind of a yeah. Excuse me.
Teach them.
What's that? Oh, cool. Yeah.
They know,
Yeah.
I don't know. So
Okay.
teach
So
them.
this is just a software, and what you could do here is, I built this with my team. You could literally just go like this, and you can choose how big the fund is, right? I don't know why it's not working. But this is a $78 million fund. That's the assets under management. 2% management fee, 10 years. If you want to make it 7 years, you can do that. So it's just an easy way to build a fund really quickly. We're doing Series A checks. We're doing 10 Series A checks. We're doing 2, so you can just kind of build the fund and play with it. But mainly it's a fund, there's a management fee. Carry is a success fee, right?
Yeah.
And then this actually already calculates the performance. So, 4% IRR. That's not that great, And then this helps you.
Not bad neither.
Not bad either, yeah. And then this helps you calculate. Look, right now I have this. Usually should be around 20%, yeah. So you could use this. I mean, in your own time, if you want to build a fund. But what you guys can do is just talk about it real quick and say, hey, we're starting a $75 million fund, 7 years or 10 years, and why you're investing. Cool. All right. Okay.